what is the purpose of today's webinar? And what I want to do here is dissect the key macroeconomic factors, mainly for the U.S., but we will get into a bit for the Eurozone as well, as that is the second half of the coin in the euro-dollar equation. For the most part, I want this to act as a fundamental primer for anybody who maybe follows fundamental news passively. You see the headlines, but you might not dig very deeply into the individual macroeconomic indicators. Also, I do want to give a little bit of a pretty much history lesson in terms of monetary policy, where we came from, and how that can help us to decide or to analyze and anticipate where we might go in the future. So for the people who are already very adept at fundamental analysis, this might be more a refresher for you, but it's still good to hear some of these things again, and maybe you'll pick up some tidbits that you may not have already known. But for everybody else, especially those maybe more heavily focused on technical analysis, I think this will be a really great course, a really good webinar in terms of being able to look at the broad themes and then pretty much laying out what to look out for in the next quarter, in the next 2 quarters. So what are the factors that we're going to discuss? I do want to talk a lot about quantitative easing and the Fed and FOMC policy. We did have the Fed talk yesterday, and so we're going to get into a lot of why the Fed is doing what it's doing, and pretty much where we are now in terms of policy, where we could be heading, and what to look out for as we go there. I also want to go over the Non-Farm Payroll report, especially taking a look at some very key releases along the way that helped shape how the euro-dollar performed over the past pretty much 2 years, and also, how we can look at the Non-Farm Payroll report in our analysis for the next quarter. I also then want to examine a lot of the recent U.S. data, which has been pointing to stronger growth in the U.S. economy, and that'll give us that'll help us to explain why we do have sort of the optimism right now about the U.S. momentum in the U.S. recovery picking up steam. Okay, so after we go through those 3 factors, those are mainly focused on the U.S., we're going to turn to Europe, go into the details of the sovereign debt crisis and the latest developments there. So that's a really big theme in the last 2 weeks. So we're going to sort of, that'll be the tail end of the webinar, and then we're going to sort of put all the pieces together and ask the questions about the euro-dollar that we want. All right, so let me actually start by bringing up a chart of the euro-dollar. Let's take a quick look at context, and then we'll go through and actually look and break down these macroeconomic factors. My chart of the euro-dollar, we're looking at the daily time frame right now, and we're starting pretty much following the financial crisis in late 2008, where we had the euro-dollar plunging from its highs near 1.60 down to 1.25. So during this time, of course, we had the meltdown in financial markets, and we had the flight to safety to the U.S. dollar, because everybody pretty much wanted the safety of U.S. treasuries at this point. But at the same time, we had very precipitous slides in global stock markets. Of course, it was just a very bad situation all around for financial markets. Now, we did come to the end of 2008, and during this time was the first time sort of response by the Fed to all this was, of course, to slash interest rates. So as we can see, we had actually interest rates were climbing throughout most of 2005, 2006, and this is actually what sort of caused the problems in the housing market in the U.S., and that once these interest rates kept going up, all the people who took out very low variable interest rate mortgages wound up seeing that their mortgage rates went up and pretty much were unable to pay their mortgages. We had a lot of defaults, and this is when we had the beginning of this subprime mortgage crisis that then moved to the financial market. Following the financial crisis, or actually during that time, we do see as the U.S. economy showed strains, we see that the Fed slashed rates. We were at around 5.25%, and we moved all the way, they slashed rates pretty strongly into the first part of 2008. We held for a little while, and then following the collapse of Lehman, we had dropped from 2% all the way down to near zero interest rate policy. So, okay, let me go back to the chart, please. Yes, we are going to talk a bit about leveraging and how we had a lot of debt in both in households, companies, and then actually moving to the U.S. taxpayer following the bailouts and all that. So we're going to get a little bit more into that story as we go. So now we're looking back at the graph of the euro dollar, and we see see that following this slide to 1.25, and we had a first move and our first foray into the Treasury's sort of extraordinary conditions and extraordinary measures in order to sort of help stop the slide in the financial markets. The first announcement came at around in the middle of November of 2009, where the Fed said that it would buy around $600 billion in mortgage-backed securities. And why did it do that was because we announced that $600 billion and as well as a program to buy back $200 billion of other securities. So mortgage-backed securities are those securities where we have pretty much backed by mortgages. So putting together all these different mortgage loans and debt and putting it together into securities, and these had been underperforming. And during the slide in the financial crisis, it was very hard to put a price to these mortgage-backed securities, and since they were on the bank's balance sheets, it caused a seizure in the credit crisis, in the credit markets. So pretty much what the Fed said is we're going to try to buy back some of these sort of toxic assets from the banks, which would help free them up to be able to give them, just taking a look at this commentary here, and this getting to the root cause of the financial crisis is sometimes depends on your point of view, but I think there was definitely a lot of blame to go around overall. But it's good to see how the story unfolded in the aftermath. So the Fed announces this program in November 2008, and then in March 2009 comes back to say that it needs to buy another $700 billion for mortgage-backed securities, as well as $300 billion in longer-term treasuries, which for me is sort of the official start of quantitative easing, and that is when the Fed goes out and actually buys longer-term treasuries. Okay, so yet again, let's just hop back to the euro-dollar pair. I just want to be able to give you guys all the context as we go along in this sort of narrative of what happened with the euro-dollar pair. So this was our first announcement middle of November. We actually saw the euro-dollar surge following that, but as stock markets around the world continued to falter, we still had this move towards safety and towards the US dollar to start 2009 up until pretty much March. And we see here in this blue candle was our announcement for the Fed to go ahead and start buying treasuries as well as more mortgage-backed securities. So this was a boon to a lot of financial companies in the United States in that they were able to sort of get rid of some of these toxic assets, and at the same time, because interest rates were so low, they could borrow at a very cheap rate, and then it pretty much helped them to regain profitability. Now, during this time, because of these policies by the Fed, we had the increase in the banks in the Fed's balance sheet. And at the same time, we had weak growth. We had job losses during this time. We were still pretty much in the depths of the recession, especially if you looked at stocks, during February of March. And following that, following the announcement of quantitative easing 1, we see a steady. First of all, it sort of helped to stem the slide in financial stocks. We're going to take a look at that in just a second. And for the most part, that's March of 2009 can be said to be the start of the global recovery. And during this time, the trade was very easy. And since the interest rates were very low in the U.S., and all these financial institutions now were able to borrow at very low interest rates, what they do is they would borrow in U.S. dollars and then send those assets abroad in search of higher yields. And during this time, the U.S. dollar is pretty much the lowest yield or the lowest interest rate during that time, except for Japan. And so the euro dollar, the euro had the higher interest rate, and in the carry trade where you borrow in U.S. dollars and you buy assets in another country, Europe was actually a pretty good destination. So during this entire rest of 2009, as we had the start of the global recovery and we had the beginning of this quantitative easing, we see the euro gaining against the dollar, rallying all the way to 1.50. So longing the euro or pretty much any other higher yielder during this time was a very sort of, I wouldn't say simple trade, but it was the common trade, the conventional wisdom trade, and for the better part of half a year, you could pretty much long the euro and forget about it. Okay,